is live in the studio to talk more on this and other banking issues affecting the larger economy. Thank you, Prof, for joining us today.
Thank you very much.
Prof, a lot of moves by the central bank, and some are saying it's getting too aggressive to the banks, and the banks might have to look the other way. I don't know how that comes to you.
Yeah, so many policies are coming out. You've mentioned the policy on loan deposit ratio, then the cash reserve ratio. Some of these policies revert. There's also a new policy on capitalization of microfinance banks. So when you put all these policies together, if care is not taken, you run into problem of policy contradictions. And when there are conflicts of policies, then you will also have to prepare yourself for some unintended consequences of such policy contradictions. And so many of them are with us today. If you notice, banks are no longer as enthusiastic as before in receiving deposits. In fact, interest rate on deposits, in some cases, is approaching zero.
Wow.
In a period when inflation rate is still about 12%. So deposits in banks today attract negative real interest rate. That's one problem. Another problem is when you look at the new cash reserve ratio of 27.5%. If you combine that with the minimum loan to deposit ratio of 65%, that's about 92.5%, which means banks are left with about 7.5% funds in which they can apply their discretion, either to trade in the foreign exchange market to maintain open position, or if the new regulations on open market operation will allow, to also trade in either the treasury bills market or in the bonds market.
Which is unattractive at the moment.
So you now have to balance all these issues. And when you now look at the new capitalization levels for the microfinance banks, then you now ask yourself, this is a country where we are still struggling to bank the unbanked, to promote financial literacy, to deepen the financial system. Microfinance banks, I don't know how many of them will survive the new capitalization level. Now banks, the basic responsibility of the banking system is to link those with surplus funds with those who are looking for the funds, the deficit units of the economy. If banks are hampered from receiving deposits due to certain policies that are not attractive to them and may not serve the overall interests of all the stakeholders, and they are also to desperately look out for those who will borrow, then you have problem with financial intermediation process, receiving deposits and getting the deposits out by way of loan. And we are not just talking of any loan, because anybody can book any kind of loan. But booking quality loan is a job for the men, not for the boys in banking. But when banks become desperate to book loans because they want to meet certain specified ratios, at times, it's time bomb.
This issue of lending to the real sector to promote SMEs and all of that, saying anybody can just walk up to the bank now and you could get a loan and all of this. The security of these funds is something that has worried me for some time. How well secured will we say when we can just let these funds go and we don't even know who's getting the money and how we get the monies back?
Yeah. I just hope time will not tell. Because our experience as a country from 1950s up till now has always shown us that we hardly learn from the crisis of the past. Most of the crises, if not all, in fact, all the crises that the banking system in Nigeria has gone through came through bad loans. And when there's desperation to lend, most times you end up with bad loans. So my fear is the desperation of today will not explode in 3, 4, 5 years' time. So lending is not an aggressive function. It's a conservative function of banks. So that is one thing we need.
A conservative function.
Is something we need to watch out for. Anybody can come in, and don't forget we still have BVN, the bank verification number has improved on that significantly. But we still have the issue of identity management in this part of the world. So there is an issue here. There is a question mark there. There are concerns there. There are some fears there that the current loan to deposit ratio of 65%, will that not end up creating bad loans for the banks that they will be struggling with in another 3, 4, 5 years' time? I say time will tell.
That's
we pray for the best.
It's a big question. Moving on now, let's look at inflation. Consumer Price Index has remained in upward trajectory for 4 consecutive months now and now stands at 11.98%. That's as of December 2019. Many analysts say the rise in inflation rate may not abate anytime soon as Nigerians now pay more for goods and services following the commencement and implementation of the 7.5 value-added tax. Inflation is also on one side. Border closure is on the other side. VAT is on one other side. All of this constitutes issues that would shape in figures that we get at the end of the day from the economic, that's talking about GDP, talking about all of that. How do you see all of this as we move on in 2020?
Some of them should help the economy to move forward.
Great.
If only we can complete the cycle. For example, increase in VAT from 5% to 7.5% is to help the government generate
more revenue.
Now more revenue will reduce the deficit budgeting that we have before us. Then the government should have more money to play around with, help reflate the economy, generate some multiplier effects, and at the end of the day, increase the real growth rate. And that should bounce on the economy as a whole, and eventually improve the welfare standards of an average Nigerian. So the man on the street should now taste the ends of some of these policies. The policies are the means. But the question is, will that cycle go without any disconnect? How soon are we going to feel the impact of some of these policies that the man on the street will be happier? Economics is no rocket science. And economic policy is good so long it can promote the greater good of the greater number. So when are we going to feel this? So the government has a responsibility before it to ensure that policies that are rolled out are faithfully implemented, that either we are talking about border closure, we are talking about increase in VAT, we are talking about some of the monetary policy guidelines that we've reviewed earlier on, that the end will justify the means. And our Human Development Index, which is one of the lowest in Africa, will have improved by the end of the day. That is the measure of the economic welfare of the citizenry. So are we going to achieve all this? That's what will determine how effective, how positive some of these moves are to the Nigerian economy.
Long run. Moving on again now, something very important now to external reserves. Nigerian external reserves recorded a decline of $4.47 billion last year. The figure dropped from $42.54 billion as at January 2019 to $38.07 billion in December. According to data obtained from the Central Bank of Nigeria, the $4.47 billion represents a decline of 10.5%. Prof, this is worrisome. At the time, the central bank governor was saying no thoughts of devaluation. Even the Bureau de Change operators came and said there should be no devaluation. But the way it looks, and if we keep on, it continues like this, it's about 10.5% decline. We're going to about 30-something. Are we not going to get close to 30 in the next few months? Where are we expecting buffers from?
It's, you feel for the Central Bank of Nigeria.
Yes, really, because they've been trying to defend the naira.
To manage the foreign exchange market is not the easiest of jobs.
It's not.
And you will notice that over the period, the Central Bank of Nigeria has been intervening in the market by pushing out
Funds.
foreign exchange into the market, just to sustain that rate and maintain some stability. And you will notice that Central Bank has succeeded in doing that for quite some time now, maintaining stability between the official rate, which is about 305, and the other rate, which is about 360.
Market.
But the question is, for how long are we going to do this? Don't forget the foreign exchange market and the foreign exchange reserves. They are under severe pressure. We 90% about of our foreign exchange earnings comes from oil. And the per barrel, the price per barrel of crude went down within the last couple.
Yeah, so thanks to coronavirus and all of that.
Of weeks or whatever, because
Really
China,
worrisome. Yes.
a major importer, is challenged.
Battling with corona.
So, if we have a problem earning what we used to earn from oil and gas, it will bounce on our foreign exchange reserves. And the test is a very serious one, because in international trade, if your foreign exchange reserves is unable to support at least 6 months import bills,
there's a problem.
you are technically insolvent as a country. So in the midst of other pressures coming to central bank as far as the application of our foreign exchange reserves is concerned, we have to service our debts. Don't forget our foreign debts. We have to also cater for some other things coming. We will have insecurity issues. We need to expand more, even though we are trying to borrow. So all this, then you ask, for how long can we sustain this rate through Central Bank of Nigeria's intervention in the market? That's why somebody said it's like naira devaluation is becoming inevitable. And if that happens in the midst of all that we have said, then one will feel for the likelihood of further decline in the welfare standard of an average Nigerian.
That is not good news, Prof, but that's reality. If you want to really face it, pure economics there. Let's now look at the outlook for banks in 2020. That trajectory of growth in the revenue of banks will stiffen as risk assets portfolio expands. However, this will come with increased systematic risk, given the pace of growth and the still fragile state of the Nigerian economy. According to Cardon Securities, in its new banking sector outlook, the cost of risk across the industry will spike going towards 2021 financial year. Non-performing loans will moderate following an initial dip that will follow the significant loan growth. A lot of risk in that sector. For 2020, what do you think the banks will have to do? I was speaking with Dr. Adedikpe, and he was giving me some things that the banks might have to look other ways, other portfolios, maybe investing in other ways. What do they have to do now to be able to remain where they used to be?
The reality of it is banks are going through tough time. And that's why I keep advising care, especially in the loan market. Because from experience, when banks' sources of revenue start to shrink, desperation comes in. Book big big ticket transactions, earn your fees, and so on and so forth. So what can banks do in terms of application of digitalization to deepen banking services and now become more fee-based institutions rather than interest income-based? So how can banks make use of online banking services, digitalize their operations to ensure that they improve on quality of services, they extend banking services to the unbanked, and earn substantial fees and commissions as part of income for 2020. That's one thing. Well, somebody has cited an example that if banks are paying little to nothing as interest on deposit, and it's still the interest rate, the lending rate is still hanging up there, is that not a wide margin? Well, how sustainable? And I am sure Central Bank is reworking some of these things. Don't forget the OMO market, that's the open market operation market. It's no longer that available to banks, where they could answer very, hot money, quick. That is no longer available.
Wow.
So 2020 is likely to be a tough year for banks, and stakeholders across the board may also start seeing the likely impact of those challenges coming in 2020. So banks need to put on the thinking cap, not even thinking outside the box now, but thinking without any box. You see how can they, you see some of the banks are also extending their services outside the shores of Nigeria, and so on and so forth.
Yes,
so this is time to re-strategize and ask, how can we deepen banking services? How can we expand the quantum and quality of services that we have to offer our customers? How can we expand our operations to areas hitherto unbanked, so that we diversify our portfolio, we diversify our revenue sources, and at the end of the day, we still make good money. So these are the issues banks you'll be thinking about, and I'm sure the boardroom of banks
working at the moment
will be very, very, very busy thinking about some of these issues right now.
Professor Segun Ajibola, it's always nice talking to you. Professor of Economics at Babcock University, Ilisha Remo, and immediate past president of the Chartered Institute of Bankers of Nigeria. You're indeed the right person to talk about banking and the banking sector. Thank you very much for your time on the show.
Thank you very much.